here.
Who goes first? Gosia, no question yet, please.
Gosia Egiman, Lombardy. I have a very general question. During these 2 days, we got clear vision. If I look at PLDL, all lines, we got clear vision what you want to do about cost savings, what you want to do about all reduction items. Now, if I go to we also got the presentation on different brands, the opportunities of different products that can be deployed globally or to different countries, extensions, and so on. The question I'm asking myself after all these 2 days is, what prevents you, as of today, of defining exactly what's the growth potential and what resources you need to put behind? Because what we understood right now, that you clearly see what kind of savings you can do, but it's not clear yet how you want to use these resources and what kind of growth it can generate and what kind of marketing spend is needed, what investment in R&D is needed. So can you describe more the process that's going to be deployed right now to define precisely what kind of growth we can expect?
I would really want this to be so simple too. I mean, but I have mentioned Nestlé is many moving parts, and decisions are made on many levels, especially also on support behind brands, etc., commercial programs, etc. is done in the markets. We have programs here on R&D. We have also quite a lot of product development in our factories. We have 450 factories, and these are all moving parts. Actually, I'm privileged because I'm enjoying the low of the big numbers. When you add it all up, it's smooth the whole thing out. And this is like a bicycle. It is permanently adjusting, seeing. We have every month an executive board where we go really in the details, see what works, what goes faster, what goes slower, and adjust permanently. So, but the fundamental thing is that we do see upsides on operational, and that's NCE, and structural resources that we feel are locked in, where we can use them better somewhere else. We do see needs of higher R&D spend, because I really believe there is a competitive advantage, and I hope we could share some of that with you. And there's quite a lot of more deeper, I would say, science coming in that we want to use to drive our growth and profitability. There's also more need for in competitive intensity behind our brands in the future. We want to, so what we do see is that we're going to unlock resources. We're going to create also through innovation offers and products that do have better margins, hence portfolio management and the mix shift. And we're going to use that, and basically we say, to simplify again, is to have more brand support, to compete better in the marketplace, and also returns, which is bottom line and return on invested capital. Now, how much, what, and here, and I understand you. You wanna have a figure. But look, top line, bottom line, capital efficiency consistently. That's what we promise. And we're going to handle this as a bicycle, permanently fine-tuning this equation. That's a commitment. That's a strong commitment. And to do that consistently over time, good times, bad times. Sometimes you have tailwinds, sometimes you have headwinds. Then we have to push a little bit harder. That's actually what we do now for quite a few years already, pushing harder. Ask the people. So, I understand your question. You understand that I cannot answer it like it's going to be 4.1, 4.2 here, 3.2. I don't do that. That's not how we can manage a company like ours. But what we want to do is to show you some reliability and consistency over time. And we want to be on the higher end on growth, definitely.
Who's next? I think Alain has his hand up since a while.
Thank you very much. Alain Oberhuber, Mainfirst. I have a question regarding Brexit. Have you taken any precaution, or is it business as usual?
No, I called every Englishman. Look, first of all, we have a natural hedge because we produce so much locally, and there you go. So that's a natural hedge we have as a company. We are basically producing and selling locally. We have local management. We know how to live in the reality and all that. So that creates a little bit of, all right, let's see, and I think wisdom is going to prevail. I'm quite confident that wisdom is going to prevail, and let's just see. I mean, look, if first of all, there's no specific need of saying, look, if that happens, we have to close the factory A, B, C, and D. No, because we are hedged there by localness. But again, there's so many things. What if? We have some contingency plans on big things. We have risk analysis framing, which is quite explicit on things. And you know what the biggest thing is that we have on that risk management? Trust. I mentioned it before. That's the biggest one. So, and we have some examples, rightly or wrongly, but that should be showed here of when you lose trust. That's millions going. I don't think Brexit would be one of them hitting the top 10 list of Nestlé on risk assessment.
I think it's part of our daily business. We have talked about Argentina, we could talk about Venezuela, we could talk about Russia, so I think it's part of our daily business. We are obviously running a certain number of scenarios and protecting our interests, be it on the assets or liability side for any of these cases, but it's really business as usual, I would say. And especially so that we don't know what will happen, but we have to take that into consideration.
Patrick?
Patrick Schwendimann, Zurich Cantonal Bank. In terms of the portfolio management, how much in terms of sales have you do you still have to fix or sell in the future?
Fix or sell. We had something like 10% that we have been looking at, and we have done something, 80% of it, something like that, 80.
Of what we had 3 years ago.
We're quite stubborn too, in the sense of we have quite a few that we want to fix. Fix means not will bring it out of negatives, but doing and bring it to be accretive to the mix. But I think we have done quite a bit. Now, it's a dynamic tool. It is moving in time, and certain businesses that we are doing well may shift into a lower gear. There you have. So it's a permanent thing that is linked with our yearly cycle of strategic planning in our company. So the tool is not a tool that Francois uses, and that's it. The tool is something that everybody in the market uses every year through his own planning process. And the strength of the tool is that it has allowed us, because that's another new tool, portfolio management we have done always. If not, you would not go after acquisitions and brands like we did. What we did, though, a few years ago is really standardize it in such a way that, and discipline it in such a way that everybody speaks the same language, and that we don't have these classical corporate discussions of, yeah, but that's your figure, my figure is different. No. And that is the discipline on 2,200 cells that we have driven by the market. We can then here aggregate, also thanks to the data systems we have, we can aggregate category in a region, or a category worldwide, or a geography. And that is what we do then on a higher level. And that's then the more broader portfolio management that you may have seen some projections from. Every market has the same map charts. So it's a permanent tool. And so, and we always going to have businesses that are starting to fade into territory that we want to clean up, or we want to reinvest or redefine. And we're always going to have parts of our business that we say, look, this is not anymore for us. Other players may be better at it. So it's, but I think we did quite a bit. You saw it, over 2 billion of selling off. Yeah, but that doesn't mean that was it. We have done a lot of fixing, also, in the meantime, and we have also accelerated quite a bit. In many categories, we have put more money because it's working well, and we want to surf the wave. And coffee is one of them, but in culinary we have done Kit Kat, and in certain brands, confectionery. So it's an ongoing tool, a very good one.
Okay, who's next? Céline, please.
Yes, in 2015, margin expansion in food and beverages was 30 basis points, and there was a drag from skin health and health science. I would like to understand, whether we are now, I understand that there's faster growth and you want to put the investment behind it, but have you now put enough investment in order that the margin of this business going forward is stabilized or going up. So maybe if you can talk about the outlook for that, and where was the money spent effectively?
Where was the money spent?
On health science and skin health. Because I think the margin went down a lot. There was the issue of the rebates, the issue of the acquisition, but even beyond that, there was still a big gap.
First of all, let me. I don't like when we say, where did you spend the money? We want to invest. It's an important difference, though. But these are platforms that we're actually resourcing now. We are building them up. So, and yes, we want to do that again. I'm not saying to you, look, we are building new platforms for in 5-10 years' time, so wait for us. We're going to be not driving results during that time. Again, we are dancing on that fiddle line of combining short-term delivering and long-term investment and delivering then later on. And these are two platforms that we are investing in for the time being. So adjusting, investing, profiling. We have engaged and we have do some de-risking there because the timelines and the engagements are a little bit tougher, and happy to have François there who knows what we're talking about. But these are the things we're doing. So what we do want to do there is that growth, they should be accretive to growth, definitely, and they should not be a drag in the short term on the bottom line, because there, with a higher risk profile, I need more bottom line. That's a logic. And so we want to see that in the near future, starting to be accretive to our business model.
Eleonore?
I'd just like to come back to what you were saying about global procurement and wanting to get a feeling of to what extent foreign exchange considerations come into play here, because you mentioned the natural hedge that you have in the UK in the context of Brexit. But if you're going to start centralising a little bit more of your procurement, it might lead to more variations in terms of your foreign exchange exposure.
I give it then to you, but basically also having a global procurement doesn't say everything is going to pass through Vevey. So we're going to have that again, globally framed, globally steered, globally structured, global deals where it makes sense, but call-offs in factories and quite a lot. We're not going to ship products through Vevey. There's not enough highway for that. So again, shared services or sharing, scaling up doesn't mean centralizing per se. That's my first answer. And I wouldn't like to lose this natural hedge we have. We're not in the speculation business of currencies per se. So I don't want to lose that. But there's certain hedging to be done to stabilize our cost base, basically. That's why we also have some dimension of futures only to stabilize our costing. Why? Because we know also that pricing is not as agile towards retailers than maybe sometimes our cost base of raw materials. That's my answer.
I think that the main objective is obviously to leverage on scale as far as procurement is concerned, which is the reason why we can buy more above market, either regionally or globally. That being said, you have a point, which is that it could impact negatively our bottom line in terms of foreign exchange exposure, but that is easy to manage because we can use hedging instruments. We can't hedge, I don't know, if a given market, I mean, the currency is falling down the cliff, that we can't hedge because there is no transaction there. Whenever we have a transaction of import, export, and so forth, that's relatively easy to hedge. It may have a cost, though, but I mean, so this is not an issue at all.
Joanna?
When you mentioned that you saw or feel there is a greater need for higher investment in R&D because you want to extend your competitive advantage, I think we're very supportive of that if it does extend your competitive advantage. The question is, could you give an idea of how much, do you have a clear path already or a visible path as to how much of this can be commercialized and how much of this will be, I know, pharma type, trial and error sort of R&D, excuse the term. But
that's always the 100 million question, right? R&D. First of all, it's not a matter of just more. I also think we have upside in structuring R&D maybe better. We have these two dimensions, category-wise and then transversal technologies, and there we are structuring, and there's actually a restructuring happening also in our R&D setup to go for more efficiency. I say it more as a general concept. Somewhere, you see it all over, our strategic direction of added value, links of food with nutrients, nutrients with health, and that's through normal daily food and beverages. But then also these other dimensions that we are building up is going into levels, additional levels of knowledge, science, development, that if we want to build competitive advantage, and there's more of that, the more science link your businesses to a certain extent, if you do it right, the more competitive differentiation you can have. I want to be there. You just think, well, you saw some of these sugar, material science, because food was, and I have mentioned it before, food was texturization, raw materials, and supply chain, processes, flavorization. We're good at that. If you start to move to another layer of material science, how you can actually make crystals that are different and dissolve differently, you saw that, I think, right? That is another story. And that brings it to another level. If you think about how food is linked with health in a much more direct, health-inducing way, and you think about the microbiome, and you had already quite a few of brutal answers to that. Probiotics actually is about the microbiome. There's so much more that goes into that direction. You saw the example of epilepsy. Think about that. The example you show. These are just examples of top of the icebergs. And if you then go underwater, it's an amazing amount of potential that society, not only Nestlé, that society is starting to discover. I want to be on the front line there, whatever touches nutrients. You don't want to go to pharma, but nutrients. And nutrients is increasingly having a functional role there that is to be understood. Well, to understand, you have to study. To study, you have to invest. That's why I say I do see R&D having a more predominant role and cost linked with that in driving the success of this company by differentiating and finding solutions before the others and building our brands with these additional arguments, and you go on. We have products like VitaFlow. I could tell stories. It's really motivating to see what food and the right formulation can do to health, especially in babies. You can make a difference between handicapped and not. Well, we want to be there. It's good for society, definitely, and I think there's business purpose linked to that too. That's why I say. Now, how much is that? I don't know. And that's also why we don't want to do it all under our roof. We want to share. We are much more in networking, in growth funds, in venture funds dimensions, and being part of startups, and having outposts somewhere to be linked in. Our R&D also is more and more having the right people, not doing these things, but knowing what's happening in the world. So we want to have capabilities of doing things, processes, we have that, product technology centers, but we want to have also bases of the best guys around who are really knowing what is happening and where we should engage and where not. And that is what we're building up with Nestlé, the Institute of Nestlé Health Science, for example. That is what we're doing with having connections with startups that in Boston and so on and so on and so on. So I hope we could share some of that through with Stefan Tsikas when he was talking about it. He only just shows you something. The whole innovation you saw is I hope you saw quite a bit. This is only part of. We're not showing everything because there's quite a lot of more happening that we want to surprise you with. But that's deeper science, and I think more investment.
I think we do the round of the usual suspects. Let's start over there, Robin.
We had the opportunity to over here. Sorry.
Oh, sorry.
We had the opportunity to meet the chairman earlier this year, and a sort of roundtable discussion.
All right.
And we're talking about the change in the metric for EPS growth, where management incentives kick in, etc. And that number was reduced by 1%. I think it was down from 7 to 6 or something like that. Presumably that has impacts and feeds through into the Nestlé model. And it seems to suggest that the Nestlé model, the 5 to 6, is more of an aspirational target given this low inflation. I guess the reduction in the EPS target reflects lower deflation. Is that a good way to look at it, do you think?
Well, first of all, 5 to 6, I see it as an ambition, the target. And EPS is part. So when we speak about top line, bottom line capital efficiency, that's basically something that you drive operations with. That's how you drive markets. Actually, return on invested capital per se is something that you have to see on what level you use it. If I use it in a market, and you saw, for example, Nigeria or other markets, Nigeria still has factories and investment, but some markets do not having investments. Well, it's top line, bottom line. But then we add it up on the right level to have return on invested capital. It is clear that we also use EPS and judging how we drive value creation there too. So and the 5 to 6% ambition is definitely one of these part of your equation that makes a big difference in the EPS. But we have our targets there definitely clearly too.
The largest factor influencing EPS is trading operating margin, which is really part of our incentive program anyway. And trading operating profit is in itself largely influenced by our sales growth. But obviously, so we are really looking at the entire value chain, from the top to the bottom line of the P&L.
But we're managing the whole tree. You showed it yesterday. The economical value equation, return on invested capital tree you have there, all these elements. But then how do you drive businesses and how do you commit? And then you have to have a framing on incentives, and that's what we have longer term.
But I guess it speaks to a lower growth environment over the sort of medium term. Is that how you should interpret it?
Well, I would say there's an expression of some realism, yes. Yes. And fairness too.
Who's next? Mitch.
Thanks. I've got 3 totally unrelated questions, if that's okay.
We take one and then we go around and we come
that's
back.
fine. Well, the first one is, I guess, the most important, which is lots of companies within the food and beverage industry have been able to achieve very large margin improvements through a combination of either trade budget optimization or more aggressive cost-cutting plans. I appreciate you've given a new structural cost reduction ambition, the flow-through of which is to be defined. Perhaps some perspective on why you think a similar level of margin improvement is not achievable at a company like Nestlé. Is it because you're already so efficient? Is it because of the scale and breadth of the company? Is it because your categories are relatively heterogeneous, or is there something else perhaps I'm missing?
I don't speak for other companies, but it is linked with that fiddle line between short term, long term again. We have increased our investments for the longer term too, and I feel this consistency of going. We can increase our bottom line 300, 400, 500 basis points tomorrow. Why and how? Easy. Cut PFME marketing spend. R&D we can cut too. And you go on. I wouldn't do that. I said there is this combination of short-term intensity, deliver consistently, and long-term, and that's our job here to maintain that balance. And we have many moving parts. So we do have the law of the big numbers, many small dimensions that are converging in the same direction, adding up to what we are stabilizes the numbers. But I wouldn't go to jumping on the scene and saying we're going to have 300 basis points next year, and by doing so, we can survive 3-4 years, cutting some marketing spend. We have a lot of brand momentum and all that. That's not responsible. And we owned 2 people a few years ago doing the same thing for us and having that rolling dimension going. So it is top line, bottom line increase every year. Now, 400 or 500 basis points one year and then going down and then going back. That's not our model. That's not what we believe in. It is in that balanced way. It's a fiddle line, It's a very subtle balance, but that's a good balance. And actually today, we are investing more proportionally for the future because it's intrinsic to our added value business model that I just explained also, that is more related to research. We are having a heavier agenda on innovation and innovation, which is linked with a moving and evolving society. You see, the food and beverage business is going through, I would say, an inflection point of possibilities, science again, and answers, but also needs. Call it the Millennium Syndrome. With that, everybody understands what I'm saying. The love relationship to food is changing, and worldwide, not only in the developed world, definitely everywhere. And there, it's now that you have to engage there. It's now that you have to invest or reformulate and be in the front line. So it's that balancing act, and I think part of what we are as a company, and I know you like that, but still you challenge, and that's the right thing to do. But is this consistency somewhere? I like this consistency. A little bit boring maybe, but I think also it's good for 340,000 people to know what drives us. We are much more intense than in the past on many areas, but consistent. And you're totally right to challenge and say, hey, the other guys here and the other, and we look at that too and say, well, yeah, what's in for us? What should we? And we are adapting to it. But we wouldn't jump in every pool.
But if I can just follow up, it's obviously too soon.
Can we come back?
Fine.
No? John.
Thanks, and thanks, Paul, and maybe I speak on behalf of everybody. Thanks very much for all the management giving up, a good 48 hours, and I'm sure there's a lot of preparation went into it from the IR team. So well done on that, guys.
Thank you.
A question I asked, the buyback question, if I can. You said you don't want to go back to AAA. You could go back to AAA the way you're generating cash. Can comment on that, and I'll sneak in a quick one. Is Europe doing a Japan, and is that going to be the focus for you in terms of cost cutting over the next couple of years? Thank you.
Well, AAA maybe, but we want to be gold standard in the industry. That's what we are, and I think we have, where it is relevant, we keep it, and that's what we want to do. Is it per se an objective to be AAA? I saw yesterday, was it, that how many companies do have AAA still? Not too many, but we are the gold standard in our industry. That's what we want to be. Now, Europe and Japan. You may remember when the crisis started there was quite a lot of noise, growth, Europe and all that, forget it for a while. If we go to emerging markets, there was a time that the Chinas of this world were still double digit and everybody there. We said from the start, we are an ant company, so we want to have growth also in the developed world. We never left growing in Europe. And I do believe some of the inspiration that I hope you felt a little bit with, through Kozo when he spoke about Japan, I feel there's potential in Europe too on this, of different business models. The Nescafé ambassadors, I definitely believe there's millions of small offices also in Europe. And why? So there is commonality. For me, somewhere, the reverse inspiration, the inspiration coming from Japan is saying, also in Europe, we have to bring our creativity to another level. It's not pushing the same buttons harder. It is rethinking certain dimensions. Coffee in Europe, should we go there into this? Yeah, I think so. Kit Kat. Kit Kat is one of these products that we have that has a strong, narrow personality. It is the 2 fingers, 4 fingers, that's it. He has been able to be creative in that narrow framing. Well, that's not only conditioned to Japan. So I do see a lot of commonalities of driving growth, defying gravity, and a country like Japan should be inspiration for the rest of the world. And that is what he has been, and that is what we believe in. And it should not be these answers bring over here, part of that, but also rethink in Europe what we can do in changing the business models and drive growth. We have done quite well so far, but I do think there is more. Also United States. Oh, the whole world. You see, I'm using your question for more, but the developing, emerging markets. I truly believe also there's going to be reverse innovation. China definitely, and I think Wan Ling has shared that with you too. E-commerce, the whole digital dimension is definitely so much is going to come from that inspiration that we're going to have there. That's why we engage in accelerated way in China, not only in China, elsewhere too. There's quite a lot of dimensions initiatives in many markets. Why? In emerging markets. Why? Because they don't have systems to defend. They don't have an oversight retail setup to defend. So it's like the cell phone. The cell phone was going and introduced, penetrated faster in these markets. That's why I believe in these reverse innovations in many, many areas. And that's why also a sixth floor, for example, we didn't set it up for you only, but that is permanently there to inspire our people from all angles. And you see lots of products are coming from emerging markets. And that is something where we have a competitive advantage because we do have decision makers, we have development that is local, create some complexity, but it's good complexity. It's a good investment. And COSO is a good symbol of that.
Marta.
Thank you. So some of the science you showed us from your R&D was very, very impressive. I had the impression also that it's converged more to the pharma, especially with the clinical trials, and you say you want to invest more in that. That's great. But I was just wondering, your pricing environment must be far more sensitive than that of the pharma companies, but in investment in the scope seems quite similar. So I've been wondering, how do you assess the potential return on this R&D investment into developing the functional or health food?
Well, first of all, we are not pharma. And I have to stress that, although there's some smell. There's some smell, but because you go to functional relationships with health, there you go. But there's a fundamental big difference between pharma and a company like ours. It is clear that somewhere you go to somewhere in the middle, because we speak about inducing health through nutrients and all that. There is clear when you speak about functional benefits that in a society that is serious about these things, you have to prove. We are still a Cartesian society. We have to prove. It's not a matter of belief because we observe 3,000 years and so on. So that's clinical trials, but still you have different levels of clinical trials that are fundamentally different. We still talk about GRAS, which is safe ingredients, and so on and so on and so on. So you spoke about return on R&D as something that we are monitoring too. The pipelines, the output, how much of our business is innovation that is linked with our R&D setup, and so we're monitoring. We have call it KPIs to monitor our R&D setup area by area and to see how dense the pipelines are, how far out we are, and it's clear that with health science the timelines are longer because if you do, and it is actually not easy to do clinical trials or to build proofs on things that say if you take this your whole life you're gonna be healthier at 70. You have to wait a long time. So it is clear, but there is so much affinity with what we have done. If you think about our first product, and that was because it was like obvious. You have to eat and cereals and milk, and it just goes a little bit deeper. That's why I don't believe we are pharma, and that's why I do believe our R&D spend or investment is going to be still away from what pharma has to do. On pricing, you say pricing sensitivity. We're not pharma, so there is competitive intensity. We have to be aware of that. But all the investment we do in R&D is to differentiate, to justify a margin. And it is through this differentiation that you don't, the further you get in differentiation, the further you get out of commodity, the more honest pricing you have. overpricing is not part of our business model in the sense of hit and run. I mean, it should be honest to the value you deliver. You see also pharma being challenged on that. Pharma is somewhere going a few years later than the food and beverage business through quite a few of experiences like private label we had and all that. So I observe.
Stuart.
Paul, there's a sense in the business that, you know, where you managed to grow significantly above the market in Japan and Europe, there was an intensity required of the business because of the lack of growth in those markets, which has been lacking in other parts of the business and is reflective of a lack of intensity in the search for growth across the business in general. How do you think about that or respond to that?
You speak across the business or across the industry?
Across your business.
So you say, just to understand your question, you say in Europe we saw good and bad.
No, because the market lacks growth. Your organization is then absolutely focused on driving whatever growth they can find and therefore grows above the market. Whereas in other markets you have a tailwind of growth and you're not so hungry to outperform the market because you are happy to grow in line with the market or maybe even a bit less because you've got some top line growth anyway.
Is that your perception?
Yeah.
That does look like our reality.
No, the facts are a little bit different somewhat because indeed in Europe we are delivering growth above the market. In Japan as well we do. In the US we do as well. I mean, if you look at the food and beverage market last year, it declined. I think for the first time ever, it declined by volume last year in the United States, and we are growing in the US. Might have been different a few years back though, but last year we grew as well. And in emerging market, you saw I presented it yesterday. I mean, we grew over the last 3 years on average by above 8% in terms of CAGR on sales. So we are growing, I think, above market levels in most geographies. Okay, you can always find different markets where it doesn't happen that way.
I wouldn't like to leave a feeling that we are standing up here and saying, growth, whatever it takes. It is growth with return. I mean, and sometimes you have to invest a lot to keep your position because growth comes afterwards, and so you have to balance these things out. But I wouldn't go in the direction of growth is first, we're an ant company, it's growth with returns. And you said something in the sense of maybe the intensity of resource you put to have some growth in a certain area where growth is not a given, that same amount of money there could have bigger impact somewhere else. That's a little bit your question, I think. And that's where portfolio management and return on resources is linked with. And these things have to be paced out. And we do reallocation of things. For example, during the year, we reallocate, saying, look, that's like going against the wall for the time being. Let's keep our position. But there we have tailwind, and we reallocate resources during the year. So we do that. And actually, the portfolio tool helps us there to judge the sensitivity of certain shifts and arbitration, if you want. Now, you have to watch out, too, that you don't overdo that, because you compete in categories. And you cannot only always shift from one category to another, because you have to keep your competitive positions, too. And it's not only 1 year versus another, because your positions, when you lose them, it costs double to regain them. But that's judgment. I mean, there's no formula for that, and I hope we have the right brains to judge these things on the right levels, because that is not all done here. That is done in the markets. That's why also this relatively complex structure, because you could also say, why is Nestlé not grow all managed category by category worldwide? Because of that. Because that feeling, that nuancing, and that reacting meaningfully is basically also given locally. With some regional, global judgment, you go on. So that's how it goes. And sometimes, yes, you may be right. Somewhere we have been pushing too hard versus the potential, and the return would have been. But these are the judgment calls that then the portfolio tool takes up again and say, well, the last 2 years, that was lost. Okay, fine. So what do we do now? Fix it or disengage?
Was that the question you asked? Okay, perfect. Georgios.
Given your solid free cash flow generation and your encouraging goals to improve it with increasing margins over time and lower working capital and about 4.5% capex to sales, can you tell us about your plans or desires for the use of free cash flow in terms of dividends, small acquisitions and big acquisitions?
Well, our use of cash flow is known. We have several levels, and you have shared that. It is first play short-term, long-term investment for the future on the right, supporting our brands, or what we have been discussing here. The other one is doing the investments, capex, but you see also how we are sweating our assets, and Magdi has been sharing that with you, how we go very sharp on this, and I do believe and NCE is driving a lot of efficiency there too, and portfolio management again, and combination of, and then you have giving back to people who trust us and put their money in our company, and that's and the stable way to do that is dividend, and then you have bolt-on acquisitions to keep monitoring and see what makes sense, what shows our goodwill, and you've seen there how that has an impact, and then you may have something like share buybacks, but wait, that's exceptional, and we should not overdo that. That's how I see. But mind you, the dividend policy that we had has been quite substantial. You see, you can do the calculation, but I think we should privilege that and keep that going. Again, consistency over time matters to us. But I don't know if you want to add something on this.
No, I think we have been fairly clear on that, and this is what we have applied, indeed supporting the business, securing the dividend. The dividend has increased, as you know, over the last few decades in absolute value in Swiss franc, which is quite a bold move. And then M&A, we discussed it. It is an opportunity. It's not an obligation. We need to be careful, especially in terms of returns. And then comes at the end share buyback, as Paul said, which is obviously we are not going to be sitting on piles of cash. This is not the case today. If it were the case, obviously we will return it, probably in terms of share buyback, but we are far from that case today.
Okay. Mitch, you had another one? I have in mind you wanted some more, 25 more questions.
I don't have 25, but I have two.
Let's take one.
Okay. The second one I wanted to ask was, I appreciate the attractiveness of a focus on health and wellness. Do you think there is any sign at all that focus is maybe hampering the parts of your business that don't focus on that aspect, confectionery perhaps? Are you doing enough to innovate there?
In confectionery, first a link with nutrition and finance, I don't see a contradiction there, to be very honest, I don't. I do see a company going responsibly about that category, so, and that is linked in with how can we deliver the same moment of enjoyment. You like chocolate, or?
Yeah, I look like I like chocolate. I do like chocolate, yeah.
No, my thing was a question.
The answer is yes.
But you see, and that's what we are as a company. We are a company that goes about food and beverages and the link with quality of life of people, but in a responsible way. So, and confectionery is part of that. And there's technologies, you have seen how we can deliver that, and aeration, you can put and portionability, and you go on. So now, should we drive it better? Yes. There's upside here. I mean, you just think about the phenomena of Kit Kat. We use and abuse the example, but Kit Kat is one of these that we have in our company, and it is a 75+ year brand, and it was in, I may be wrong, 7, 8 markets, basically. Now, we are a global company. We have a brand that is unique. We have a brand with a product personality that's and so on and so on and so on. Now we have it over 40+ markets, and that in a few years' time. There's upside, and it's for us to land these things. People, you can say yes, but you're a third in the global. Yeah, but that's mathematics. At the end of the day, people buy brands. And KitKat is the top 10, definitely. And it's one of the fastest growing. So I may have more of that potentially, and we work on that. You know, and I have shared with you the last time we met, like in this setting, that I have a little bit of frustration somewhere here and there, like Cahiers, and we're not going to blast ourselves on the world scene with Cahiers. We're going to do smart, tangible, on the tangent and all that, but I do believe there's upside of creating this nice, enjoyable moments in people's lives. That's also part of our business model. And it doesn't take away the fact that we're serious about nutrition and wellness.
Thank you.
Good. Let's take a few more. Celine?
Yeah, a clarification. In a few presentations, there were discussion about above market, where some of the managed zone business seem to be given a bit more of their independence to be above the market. Is this a trend? And does it mean that those companies or those categories are better managed on a standalone basis more successfully? And does that mean that your structure probably is ill-adapted to what you see right now in the market?
Well, there's a famous question between globally managed, locally managed, this pendulum always. And I have mentioned that we are fundamentally a decentralized structure. But that doesn't mean that we should be capital in everything we do. KitKat is, again, KitKat is a good example of that. We didn't have the dynamics of KitKat. Why? Because localness prevailed there, where actually a global brand offering should be bought into in the markets. And we have not one size fits all in Nestlé, so we have different business models, globally, regionally, locally. We have globally managed brands, locally managed brands. It's for us to maintain that balance again. And yet, again, the portfolio tool helps to judge and have judgment on these things. I do believe, though, that if we go to deeper layers of research, of innovation, that leveling that up, scaling that up to more markets, we call it the big three, bigger, bolder, better innovation, is definitely something that should drive a world that is increasingly interconnected. You see, we still have 170 blends of Nescafé. Then you can say, well, now come on, coffee, it should be one. No, watch out. And that's the localness, that's the 60-40 plus that drives that. And again, the fiddle line between over-complexity or over-localness. Localness should not be the alibi of not doing the right thing and taking up what globally works. And that is, again, the balance we have to work with. And that's a little bit a challenge. We have structured certain businesses globally, water, and you saw Marco, he spoke about water, and yet again, in water we have global brand, Pure Life, we have global brands, international brands, Perrier, San Pellegrino, and we have local brands. And that combination again is a winning combination, because people buy local. People in the fourth industrial revolution, people are still physical. They need to eat, they touch brands, etc. Yet it should not be all locally invented. And there's more and more is going to be global. Nestlé Health Science definitely is more global. Infant formulas is more global. Why? Because you have one drive of innovation, of understanding, of research. Purina actually is regional. Although the platforms, but the brand structure is regional, but the platforms are global. That's how we have then another model, where we coordinate the thing regionally. And actually we have a regional that is quite specific. You saw also that we have Latin America linked with St. Louis. And we have now linked also AOA with the drive, the good drive of pet care in Europe. So, and is there one, there's no black and white answer to all these things. There's judgment again and driving it, learning, adapting, adjusting. And I think there this balance, fine balance again, local and global is what works, but it tilts to more global inspiration and local execution. NBE is also a proof of that.
Okay, so I have 4 hands up. Number 1.
Hi there. I think there was a slide earlier on that showed that local companies have gained about 200 basis points of share in your categories over the last couple of years. Now, if you're positioning yourself as the local multinational, and we have just had lots more chat about the degree of decentralisation, why aren't you gaining that share, or at least more of that share?
Good question. That's how I challenge the structures too. I mean, but local competition has, and that's why we have to really go and maintain agility. But there's a part of the, you have part of the millennium syndrome that is linked with small and local. That although you are the local multinational, you're still global and multinational. That's part of the explanation. That's why also we have to watch out that we don't fall in the trap to say, oh, we have to buy all small local brands. I think we have to build these emotions into our global brands, because at the end of the day, people don't buy a brand and say, oh, that's a global brand, if we don't position it as such. So we should do a better job there. I do think also the agility to adapt to localness in a fast-moving, especially emerging market is higher when you're a local startup or you're a local player. We have a little bit more of framings and we have to make that more agile too. So there is a little bit of that agility that goes in their favor, but that they don't see we should lag that. We should build it into our model too. But totally right. You saw Vietnam this morning. And Vietnam, I was there, and you go to the street, you try to survive the motorbikes, and you see these billboards, and you see, oh, that product, what is that? We have, oh yeah, that's a local competitor, and they say, but we have that somewhere in another country. We could do the same here. Oh yeah, we do, but in another country, you see. And then if that's a high potential, we then organize to get it in. But that's because you saw it, and that's somebody doing it already, you see, because we don't have it in our portfolio there, we don't have a factory. That is where this I would say, this link in time is, and we have to shorten the time of reaction. Or we say we disengage. We don't go there because that is not possible. But it's hard to find a category where we cannot have an answer. But it's hard to find a country where we have all categories with all products and production capabilities too. So that's somewhere where I feel we are having upsides to go faster after these things.
I think that probably as well it shows one thing, which is the fact that we are not looking for market share only. I think we need to strike the right balance between top line growth, market share, profitability as well. By choice, from time to time, we decide not to go in some markets. And I shared the example earlier of, for example, water in some categories in the United States, for example, we decided not to go against label brands because there were no returns. In emerging market, from time to time, you have local players who are going extremely low in terms of price point. We are in the business of affordability, but there is a certain part of the market where we don't want to go too low either because there is no return. So at the end of the day, even if we lose market share in a certain number of instances while preserving our market or profitability, that is the right thing to do.
Okay, so Heidi.
We saw a very interesting presentation about your digital and online efforts this morning. And if I just think about what some other European FMCG companies have done, some of them have elevated the digital expert to the executive level. And I was just curious how you think about that question in terms of whether it would make sense to have that kind of a person in your executive committee, or whether it's not sufficiently strategic, or just your overall thoughts.
Everybody in the executive board is digital. It's like having an executive board, somebody that is responsible for growth. No, I wouldn't like that. I mean, or having somebody who is responsible for innovation. We, as a collegial group of people there, we're quite hands-on, and we talk about digital every time we sit together. Digital, and the people you saw are reporting into, administratively reporting into Patrice. there's Bulcke, but basically everybody is involved here. You see, even our communication guys are linked with digital, and you see one link definitely is linked with digital in the market. So I don't want to have a bottleneck on something that is one of our priorities, broad-based priorities. You see, Chris Johnson definitely is linked with digital. He's actually the hardware digital guy. I mean, so it's again an option. What you do with that is saying we take it seriously. It's true. Well, then I'm the digital guy here. I have to drive this. This is highest priority for this company. We have been accelerating this big time. We should maybe talk more about all what's happening, but I'd rather have it showing through our business performance, and that will. I'm quite upbeat of what's happening all over the company.
Alan, you have your hand up as well.
Paul, I think it was in 2011 when Nestlé Health Science was created that you set an objective of within a decade being the undisputed leader of the use of nutrition to treat and prevent chronic disease. We're sort of at the halfway stage here. Do you still think that's a realistic target? Have you been pleasantly surprised or disappointed with the progress you've made versus that roadmap?
No, we have gone a long way, and definitely on nutrients. We want to be the leader in that field, yes. And we still have that ambition. And we have driven our business that we had, and there are basically consumer dimensions. We have engaged in the right platforms. We have a lot of learning curves, that's true. We brought in talent. So the building up has moved quite a bit. We also, in that field, are taken differently than at the time, because I remember when we started, okay, what is this? So we can engage with the leaders in thinking and in knowledge in the world. So the authority of seriousness of which we go about this is there. The leadership of initiatives and platforms that we're driving also. So I'm confident that we are on the right track. And with the right pace, 10 years, well, yeah, it's definitely already 5 years. Well, 5 years to go, let's talk. Every year, how it moves. I'm upbeat.
Mitch, the last of your 25.
I don't think my last question is an appropriate last question, but I'll do it anyway. I wanted to ask in the e-com panel and also the AOA panel, you said that you think your shares online are higher than offline in the Americas and in Europe. I noticed that statement wasn't made in the AOA presentation. I wondered if it was also true there. And I accept it's very difficult to measure what your shares are online and off. I wondered what the best way of doing it is that you found, and where you think you're doing best.
I didn't hear at the beginning. You said our share?
Yeah, your share online versus your share offline. And in the EMENA presentation and the Americas presentation, the statement was made that you think your shares are higher online than off in general. And I noticed that statement wasn't made in the AOA presentation, which is arguably where it's most important. I wondered if it was still true. And also I wanted to know how you measure, because it's obviously very difficult to know what shares are online.
I rather feel, depending on category by category again, there you go. But I rather feel that we were catching up because our share online was under our share offline, that we have catched up quite heavily in the last 2 years and may have passed in certain categories. But I still believe our upside potential is online, is still in catch-up mode versus the best players in each cherry picking. And now in AOA, again, you go to country by country. I do see there's upside in general in China, but then you go to certain categories. In infant formulas, definitely I feel there's upside, although already a big portion of infant formulas is going over E. Some other people may have started earlier, but we're catching up very fast there, and I want to be leading there too. In Purina, a high proportion of pet care in China is going online. That is higher than offline, for example. So category by category, it is distinctive and different. But again, what we are engaging with, and I think when Ling shared with you this 150 years Alibaba partnership that is coming up and all that, that goes beyond actually proportionally. That should go beyond our offline. Why? Because we do believe that online is going to be proportionally much more important in general as a driver factor of innovation, etc. So, and that's where we want to be. And certain categories are more open and normal, and they have a normal affinity to internet and e-commerce than others. Then you go to Africa. Africa and e-commerce is an intriguing relationship that I mentioned it to a few of you yesterday on the table. If I were younger, I would start e-commerce in Africa. We don't talk too much about Africa. Also, we could cover that next time a little bit. Africa is for us one of these silent growth drivers where I truly believe too, we're gonna e-commerce products also specific for that region is going to bring us quite a lot of growth potential. This is a continent where we have been growing very steady, small still proportionally. The continent per se has been growing. That is one of our highest priorities. This is going to also, if you 2 steps back now, not only Nestlé, this is one of these regions in this world, if you think about agriculture and the needs for agriculture produce and all that, that's going to have an impact on society. I want to be there. We have been there now for more than 100 years. We have 35 factories in that region. Have a head start and don't want to lose it. And that not losing head start is going to be linked with e-commerce definitely. Also, some upside.
Okay, final question, Eileen. You didn't have any more? No, it's over. Good.
Well, I can ask.
No, yeah, I had your hand up, but if
Yeah.
I don't want to, good, then we call it.
She wants to ask. You want to ask?
Yeah, it was just about innovations, really. I'm trying to square your comments on bigger, more global innovations. I mean, is it more important to have big global innovations introduced from the center or innovations that are started at the end market at the local level? Because it sounded from the AOA presentation that the latter was perhaps more important.
It's a combination, and that's why I have said the small and big, but I do see so much potential of having good ideas being rolled out faster. You see, and we have to speak about failures. We failed with LC1. We still have it though, this probiotic yogurt. Why? Well, we had 5-6 years in front of anybody else this probiotic argument. We had it. And but we were Nestlé, so you go with that innovation. And you go knocking doors. You go to country A, country B, and then you see these timelines. Everybody has another timeline. No, yes, very interesting, but I have a priority A, priority B. These are innovations that are game-changing innovations where we as a company should believe in and then see how we organize it to be broad and roll it out. We're monitoring now innovations and nice and good ideas, how many countries are rolling out in what time frame. We're monitoring that now much more than in the past. Then you have examples, I mentioned KitKat already, so no. Dolce Gusto. Dolce Gusto is a classical example of where we have forced markets to roll it out in Europe. It was Europe first. There was his own head saying, we're going to do this. And we're going to do this in 2-3 years, rolling out in so many markets. And AB and the timelines were done. It was driven centrally. It is locally managed, but driven and inspired globally. And the advantage of these things is that you don't have every market saying yes, and they want to tweak things always, you know. Like a machine, yes, but my machine should be with 3 buttons, and because 3 is a lucky number. Doesn't work. And we have to have more. But that should not overrule the fact that we allow people to have local innovation too. And that combination is again a call-off. the 60-40 plus, for example, this whole way of going about nutrition, health and wellness, and preference and taste is something that drives quite a lot of localness. But it should be consumer-driven localness, not ego-driven localness. And that's judgment again. And that's where the pivotal function of zone heads and non-global managed businesses is so critical to judge that and see where what call is to be made. And I believe that there's got to be more of that global inspiration, but still local execution. And there's much more buy-in of markets. There's much less defensive attitude to saying, well, not invented here. Why? Because we have so many good examples of being part of a global resourced idea is so much more forceful and drives so much nice returns. So there's an easier buy-in. We do SKU management too, because you can imagine with localness you can have a hyperventilation of SKUs, and so we do quite a stringent SKU management. We went actually from over 100,000 to 70-something thousand. Yeah? All right, there you go. So and that's central. This is a little bit with forceps sometimes, because always you have somewhere a mother of a father of an SKU. And it's always hard, emotional. But again, there we have a lot of buy-in because you free up capacity, so less capex. You have a much easier time managing your stocks and provisions, and you don't have to sit on your knees to have all your SKUs on the shelf, and so on and so on and so on. So it just makes sense. This more global dimensions. Yeah, it makes sense.